Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. And in this episode, we're going to talk about borrowing against your royalty interests. And this is a topic that doesn't really get covered a lot on the minerals and royalties side of things, a little bit more on the non-operated working interest, but it's really been part and parcel of the oil and gas industry from the operator side, really ever since they started drilling wells, ever since the beginning of the industry. So it's certainly something that many banks are very familiar with oil and gas lending, but it might be something that most royalty owners don't know about.
No, you said it, man. Yeah, it's not something that I think a lot of royalty owners are aware of. And we're going to kind of dive into what the difficult aspects for royalty owners are. But like you said, this is common practice for operators.
Yeah, it's common practice. And they're very familiar with looking at the reserves. And we'll talk about what that means when we say reserves, and then lending against that in terms of the value of the assets that the company owns or the individual owns, and then lending a certain percentage of that for immediate cash needs or just for a line of credit so that to help fund expansion. For the example of an oil and gas company, they use this reserve-based lending or this line of credit to help fund the drilling program. So they might have $1 billion line of credit with multiple banks. So there'll be a syndicate of several large banks maybe that will have lent the company money against their assets to allow them to have the cash to go and drill new wells, because maybe their immediate needs from a cash flow perspective, it's spread out over a year. They need to do the upfront payment or upfront investment. And so this will help smooth out that whole cash flow situation. So certainly something that is not new, but the ability to lend against royalty interest is maybe a more recent development. Of course, the market for lending on oil and gas royalties is designed for those that might have urgent cash flow needs. And so typically, though, I would say these types of loans, if you're going to a bank to do this, it's not to pay the medical bills, it's not to pay school debt or a home remodel. These are high net worth individuals who are getting thousands and tens of thousands or hundreds of thousands of dollars or more per month in royalties that they're borrowing against, but maybe for more sophisticated needs, to fund an investment or to help with managing the overall portfolio. Whereas there are options that we'll talk about at the end for those more urgent needs without having to sell your interest. You can borrow against them. But we'll talk about the pros and cons of that. If you do have urgent medical bills, school debt or other debt that you need to pay down and you want to tap into your royalty income, that can be an option, but there are some caveats there. So before we dive into that, Justin, you want to talk about how banks look at oil and gas interest from a lending perspective and what do they lend against and all of that?
Yeah, absolutely, man. And so it's kind of unique in that it's not something that mineral owners are typically a world that they're working in. And the challenge comes in that there's a substantial amount of paperwork involved with a royalty loan. You have to get an appraisal and evaluation of the royalty. And they're really specialized resources as far as knowledge goes. And a lot of banks, it's just not a cost-effective thing for them to do to offer small loans to individuals. And Matt, this is different when you get into like managing reserves, because like oil and gas operators, they already have an idea of what their reserves are. It's something they're keeping an idea on. And when you get into the bank side of it, they consider it to be reserve-based lending. And it's a financing method primarily used in the oil and gas industry where those loans are secured by the oil and gas reserves, whether they're currently producing or even still undeveloped. The loan amount known as the borrowing base is determined by the value of these reserves and can be adjusted over time. The borrowing base is calculated by evaluating several of the key factors you would expect, which is the quantity and classification of the reserves, such as are they proven or unproven, verified by independent experts, projected oil and gas prices, expected operational cost, required capital investments, and so on and so forth. And the borrower repays this loan using the revenue generated from selling that oil and gas produced from the reserves. So Matt, for the bank, if they can have all of those pieces and an idea of the facts, it can be a pretty stable investment. They kind of know what they're getting into, but it requires a lot of unique information that your local bank is not dealing with on an everyday basis.
Yeah, that's a great point. And for these banks, there's really no upside. If commodity prices go up or you make a big discovery, they're not enjoying the benefit of that. They're generally just want to ensure that the payments are going to still occur under difficult times. And so, because of that, the underwriting criteria is often fairly conservative, just for good reason, because they don't want a bad loan to take the bank under, especially if you talk about these large banks that are making $1 billion line of credit for these oil and gas companies. And certainly with the history of the oil and gas industry, burning through cash and destroying value over the decades, especially during the shale revolution at the beginning when they were just really drilling and were not bringing in more than they were spending. When the market turned, many of those companies went bankrupt. And so a lot of these loans had some issues to it. So certainly banks are conservative, they're careful, but the RBLs have been the norm in the way of financing oil and gas for decades. And so, again, like Justin said, they're willing to loan on a fraction of the assets that the company owns. And so that is secured again by the interest in those oil and gas reserves. And the way that they do that, there's a reserves report, and they have independent engineers typically within these large banks that will work with the company's reservoir engineers and with their independent auditors to ensure that the assessment of the value of those reserves matches what their understanding is and that they're on the same page there. And then from that, they can offer, pretty decent interest rates. And also based on the company itself, the risk level and, what else is going on within that company, they'll look at all of those factors to assess the likelihood of that being repaid. And so again, it's something where this is done on a periodic basis. So this can be done quarterly. Basically, they meet with those companies to look at their latest reserves updates. And certainly on an annual basis, they'll take a look at perhaps reassessing the value of those reserves. And then they'll adjust that RBL, that cap on that loan based on the value of those reserves. So for example, if commodity prices fall, it stands to reason that the value of the reserves will fall accordingly, causing the amount of that RBL to fall as well. So effectively what that means is that they have less to borrow against. And so that limits the amount. And typically these companies aren't going up to that full RBL amount. They're below that they're using on a regular basis to fund their capital program to drill new wells or things like that. But then they have that money that they can go and get if they needed it. So in general, I think just an understanding of that reserves-based lending is important when we talk about lending for oil and gas royalties, because for really large oil and gas royalty owners, this is an option in terms of lending against your assets and lending against those future cash flows. So it is something that for major mineral and royalty owners is something to be aware of, something to understand, and then something to leverage if it makes sense for you. So I think that's really an important thing to understand. And then we'll talk about, again, that other option. So not all of us are getting, hundreds of thousands of dollars a month. And what does that mean for us? Do we still have the option to lend against our minerals and royalties? And what are the pros and cons of doing that? We'll talk about that here in a second as well. But Justin, before we do that, you want to talk about some of the risks of borrowing money against mineral rights?
Absolutely, Matt. And it's the things you would expect. The price of oil and gas fluctuates over time, and commodity prices can really be volatile. And as the prices fall, the reserve-based lending can be reassessed, as Matt mentioned. There's also the loss of production that can occur when they're required to shut in wells, stops for repairs. Maybe that's political issues going on where drilling is being impacted. I'm sure, Matt, in a scenario where you have mostly state-owned minerals, like in New Mexico, if your portfolio was heavy there and the political winds changed, I'm sure the bank would be considering that. And pretty much any of the things that could impact oil and gas. And oil and gas companies mitigate against the risk by ensuring that they borrow against a diversified portfolio. So like with the example in New Mexico, they're looking for operators that have a wide range of minerals in different areas, which would certainly decrease the risk. And they look at concentration risk and are more inclined to lend against those diverse portfolios. Another thing, Matt, that they have to be very careful of is that the evaluation of the oil and gas interest you're borrowing against, they're not going to be heavily affected by that drop in price. So when oil and gas companies are figuring this RBL basis, they're looking at a conservative commodity price. They're not going with the highest price in the last year. They're kind of trying to find the middle ground and protect themselves against the price going down. And then clean title to the interest is something that the bank's going to be looking at as well. They want to ensure that you really do own it. So in a scenario of having to seize it, that they would own it as well.
Yeah, those are great points. And I would say that if you look at, that diversification example again, I think that would look like where you maybe don't have, large interest in just a handful of wells, but you have interest from multiple wells, maybe across multiple drilling spacing units, or maybe in different basins or different states, like Justin mentioned, so that if one area there's a particular issue that doesn't adversely affect your ability to generate revenue from that asset, you'd have something else to sort of make up some of that ground. So it's sort of that mix that they look at, and they want that mix of commodity price exposure as well. There are ways to mitigate against that. So again, if you're a very large mineral or royalty owner, or again, think like mineral funds or funds that own non-operated working interest, or again, oil and gas companies, they'll actually hedge some of their production so that they have that very regular and predictable cash flow in the future. So they might have, 50% or 30% or whatever that percentage is of that future production hedged. And they do that by buying options contracts. So for example, maybe the price of oil is $75 today, but they can hedge a portion of their production for $70 in 2025. So a year from now, for example, so that for that full year, they'll hedge a certain percentage of production at that fixed price. And there's a cost to that. But then also what that does is it's sort of like an insurance policy that if oil prices fall and now they're $65 per barrel or even lower to the point where it's below their break-even cost, they have a certain amount of that production that is hedged that is ensuring that they can repay that loan, ensuring the value of that asset stays at some floor level and won't go any lower than that if the commodity prices fall further. So that's a strategy that a lot of larger companies will use. And again, if you're a large mineral portfolio, that is certainly something that many are now looking to do. Again, those are traditionally things that have been only done by the oil and gas companies, but in this minerals and non-operated working interest space, it is something that many large investors are looking at, or large family offices are looking at those to, again, ensure some level of performance of that investment that they have. So, Justin, let's talk about some of the benefits and some of the disadvantages of these reserve-based loans. I would say, first of all, from a benefit standpoint, it's pretty straightforward. The companies, again, because the history of this, they know how to underwrite these loans. They're flexible in nature around drawdown and repayment profiles, so it allows the companies or the investors that are using these loans flexibility to use it to fund future investments, or to maybe not have to sell interest. They can hold on to a larger percentage and things like that, and benefit from the upside of that. So again, it's great for those companies that have the asset value on the books, and especially if you're thinking about like a new company. This is the way to think about this. Say that Justin and I went out and formed an oil and gas company, and we had some amazing acreage in the core of the Permian Basin, let's say, and we just need money to go and drill the wells, right? We have the leases secured, we have contracts lined up, we have everything ready to go, but we just don't have that cash flow from existing wells to help fund the drilling program that we have set out to do. Well, if we go to the oil and gas lenders, like, large banks or, community bank, and say, hey, we have this portfolio that we want to borrow against. Can you help us out? And they would say, okay, let's take a look at it. We'll run the reserves. Well, yeah, okay, it looks like the approved undeveloped reserves of this asset is worth X, and we'll lend you a percentage of that. And that may allow us to go then and drill a couple of wells to secure those leases, to book additional approved reserves, and to grow that asset base and generate cash flow. So once we have those producing wells, now we can use that to help pay off the loan, and then also to help fund future drilling operations. So that's a case study where, you're just starting out, you need money, you have a certain amount that maybe you have in the bank in cash, but you just don't have that. You're in that pre-production phase in kind of the life cycle of the company, and you need to borrow some money to make it all happen. And so that is a great use case for that. But then again, there's risk that goes with it. Justin, do you want to talk about some of the disadvantages of reserve-based lending?
Yeah, absolutely. So as you mentioned, Matt, it can be reevaluated and restructured, which I think is really one of the main points. Because, in the scenario you're talking about, if you're a company that's out pre-production, if there's a big crash in the market as far as oil price goes, or some other major thing that happens, you could have money you were depending on to move forward. Then that loan gets reevaluated and restructured. The shorter repayment periods than some other funding options can be somewhat of a disadvantage with that. Again, there's that refinancing risk. You have to have that security required. So you would have to have your title work in place. You would have to expect to have a conservative evaluation of your assets. You're not going to get the top dollar you've ever seen for those. And then you're going to pay the fees plus interest for that loan. There also could be some paperwork to jump through and hoops to jump through. Again, this is common in the oil and gas industry, but if you're new to this, it's going to be a new process of jumping through those hoops and getting the paperwork done and working with the banks to have it evaluated. And then last but not least, you'll most likely need a personal guarantee. So the bank's going to want that extra security from you in the event that things go awry.
Yeah, that's a great point. And that's, sometimes can be a limit, if you don't have the other assets out there or if you're not in the situation. So this is, again, for a unique situation, typically the very large mineral interest owners that are getting a lot of money each month, and just know that whatever the case, if you're getting an RBL, line of credit, that your loan is subject to being reevaluated, at least on an annual basis, if not more frequently, and restructured. And so again, it's not something you're going to want to borrow all the way against the full limit, because there's a good chance that when that gets lowered, you're going to have to pay up in order to maintain that line of credit. They're not going to go out on a limb to allow you to ride that out. So just know that. So again, looking at banks, so types of banks, Justin, we've talked about banks that have energy lending departments, the obvious, like major banks you see on press releases for large operators, or Wells Fargo, JP Morgan Chase. But there are also small regional and community banks who would probably be able to underwrite much smaller loans. So again, for Wells Fargo, JP Morgan, probably you can't even walk in the door unless you're borrowing, I would say 5 million, but probably more like 10, 20, $50 million. And so that would require obviously a significant amount of cash flow to offset that, or significant asset base to offset that. Now, your small regional community bank, maybe you have a relationship. If you're in Texas or Oklahoma or other oil and gas producing states, look at those types of regional and community banks that are familiar with oil and gas lending, that have underwritten smaller loans for small operators in their area, or, for other mineral and royalty owners. And, they might be able to underwrite a smaller loan, maybe $250,000 or $500,000, because they want to build that book of business in their energy lending portfolio. And they're looking to develop those long-term relationships with customers, knowing that, hopefully it will lead to future business in other areas in their bank. And so that is the type of bank that, for like a mineral and royalty owner, if you're getting, say minimum of $10,000 per month, and you want to borrow against that, or maybe, get into the hundreds of thousands of dollars a month, those are the types of banks that are looking to form long-term relationships with their customers and allow customers to borrow against those smaller amounts. Again, those types of loans generally require personal guarantee, which would mean a credit check and things like that. But, if you qualify and you get an RBL type of a loan where you're borrowing against the reserves or borrowing against that cash flow, they're going to allow you to keep your royalty interest in general during the term of the loan, and allow you to make the payments directly. And so that can be a benefit because you maintain control over those interests. And then, again, because they have that personal guarantee, your credit is basically what's they're relying on to ensure that you're going to pay that you've had a history of repaying loans like this before, you're a trustworthy customer. So just to wrap this up, in terms of reserve-based lending or borrowing against your current royalties, most banks will lend up to, say, 25 to 36 times your monthly cash flow. So to put this in perspective, you'd need to be receiving more than $10,000 a month in order to get a $250,000 loan. So that kind of helps you understand, okay, I want to borrow $250,000 for this other investment that's a short-term, like bridge loan type situation. I can borrow against my royalties. I'm going to pay it back in 6 months or whatever. How much do I need to be receiving in royalties in order to sort of give me an idea of what they're going to be willing to lend me? And that's kind of a rule of thumb. Now, of course, they're going to do a much more detailed underwriting. They're going to forecast production, from those wells at lower commodity prices. So if that $10,000 per month is based on, $100 oil, well, they're not going to let you borrow based on $100 oil. They're going to be underwriting that probably at whatever the current bank price deck is, which will be much lower than that. It'll probably be closer to, say, $75 or $80 or whatever it is at the time. This is something, just a quick tip. If you want to understand what the bank's view on commodity prices is, even if you don't plan on getting a loan, you can go to banks that do this type of work. And in particular, Bank of Oklahoma, BOK Financial, they have a price deck that they publish, I think, on a monthly basis. And then there are other banks as well, like Citizens Bank, for example, have an energy lending department, and they publish a monthly price deck on oil and gas prices. And so, these are good resources because you can look at the NYMEX futures price and then look at what the banks are saying. And oftentimes the banks will be a little more conservative. It will be a couple of dollars per barrel lower, certainly in the near term. But then maybe you can see 9-10 years from now, like, what are they underwriting in terms of their loans? What do they think commodity prices are going to do? And you can use that as a way to kind of gauge from your own personal standpoint, what's the industry looking at in terms of commodity prices? And you can use that just as a reference if you want to forecast your own future royalty payments, knowing that, of course, prices of oil and gas could go up and down. But it's a good piece of information to have as a mineral and royalty owner, so we understand where the market might be going in the future. So definitely take advantage of that. It just requires usually giving them your email address, and you can sign up on that monthly newsletter and get copies of those price decks. So back to the other side of the coin, Justin, what if I don't make $10,000 per month in royalties, but I need a loan? What are my options?
So there are options, Matt, and these are going to be higher risk, higher interest options. But there are some lenders that allow borrowing small amounts, less than $250,000, but they require a promissory note. Maybe there's a deed of trust, a transfer order that requires those payments to go to a trustee during the term of the loan. The royalty checks then would go directly to the trustee. They would apply the payments to the loan's principal and interest. And then when the loan's repaid, the trustee would reconvey the deed of trust and then issues a cancellation of the transfer order, which should allow future royalty payments to go to you again. And Matt, there's some inherent risk with this. It's obviously something you have to manage. You have to ensure that they're making that transfer back, and you have to trust the person who's holding the payments, that they're doing the right thing. And they may not require a credit check, but again, they're going to have a lower loan to value ratio. And many companies, they advertise the ability to borrow up to 60% of the value, but that's going to be based on so many factors that impact the current state of the market and everything else that's going on.
Yeah, and those are, again, going to be conservative assumptions on what the future commodity prices are going to be. So these are a potential option. Now, I would say it's kind of a last resort type of an option. I wouldn't necessarily go use this proactively to go invest in something or to, do something that is discretionary in nature because of that risk that Justin mentioned. It's a trusted third party that you're relying on them to fulfill their end of the deal in terms of reconveying that interest over to you again so that you start receiving royalties once that loan is repaid. I could see a scenario where if this is kind of a shady company or they go under, you can't contact them, you're sort of, even though the loan has been paid, they're receiving royalties still, and you'd have to get an attorney to go after them. And there's some legal fees that would be associated with that and the time of pursuing that. And a lot of times it's just not worth the headache and all of that. So there's a risk to it from that standpoint. So certainly you'd want to make sure it's a company that's been around for a long time, that has a track record of reliably reconveying the interest back to the mineral interest owner once the loan is paid off. And again, I think by making sure these loans are small and manageable and the duration and term of the loan, in other words, is just a 2 to 3 year time period, then that is somewhat mitigating against that. But then again, you just have to trust them that they're going to do their part and reconvey the interest back to you. So the lien against it is canceled and all of those things. So it is an option out there. If you are receiving a smaller amount, they may lend up $5,000, $10,000, so very small amounts relative to the other things we've been talking about. But just know that you're taking on a bit of risk in doing business with these types of companies just because of that level of trust that you're putting in them to do the right thing and to make sure that they give you back that interest basically when the loan is paid off. So just know that is an option, but then there's some more research, some more due diligence for sure, getting references, looking at the history, looking at their complaints against these companies. But again, if they've been around for 20 years and they're reliable, they've been doing this for that time period and they've had no issues and they're well capitalized, they're not likely to go under, then it may be an option. But again, do your homework. Don't take this as investment advice or legal advice. Certainly get help from a trusted advisor if you're going to look at this as an option, because if you're in this situation, often the times the decision is, do I sell my interest because I need the cash and this is my last resort, or can I borrow against these interests to get me by and then just be able to hold on to them and pass them down to my kids. So pros and cons either way, but I think it's important to understand that lending on oil and gas royalty income is a thing. So you may think, well, I have to sell. That's the only recourse I have. But then, another option for either proactively doing this to help manage a broader portfolio for large mineral interest owners or royalty owners. And then also this other option we just mentioned for folks that are just kind of in a bind and need a short-term loan and want to leverage their mineral assets to do that. So it can be an option as well.
Yeah, it's an interesting option, Matt, and not something that you often hear about in the mineral owner world. It is commonly done by operators like we mentioned, but not as much talked about in the royalty owner.
Yeah, exactly. So, all right. Well, hopefully this has been helpful. Again, we'll link to resources mentioned in the show notes, which can be found at mineralrightspodcast.com. And we'll see you in the next episode. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.